panel, all the new judges that have given up their time. Thank you very much for that. I hope it's informative, I hope it's enjoyable. A little bit of intro into the CAPISM simulation. So, as far as the delegates know, they're probably tired of hearing my voice, because there's my face. But the CAPISM simulation is designed by a company called CAPISM, which is in the United States. They have 140,000 students that do their simulations every year, from the likes of Harvard, Berkeley, Vanderbilt, some of the Ivy schools. And it's sold throughout the globe. So all over the world this simulation is sold, and it is their most complex, their most difficult, and their most intricate simulation that they offer. So this is not Mickey Mouse, this is real stuff. Let's go to the real world instead. So what we've embarked on is each delegate has formed a syndicate, which is a company essentially, and has started off running a $100 million company, and they compete against each other. So their decisions and their impact, or their decisions impact the other syndicate, which are their competitors within the simulation space. And what we've done is we've managed to run this through 8 grueling financial years. So each year we get a new report which has been shared with you called the CAP Cohort, but that's some of the outcomes of the decisions that we made after 8 years. With this simulation, what we did is when we started it, we ran it in different market segments where there's continuous and stable growth. And what we realized when Corona started is that this perhaps doesn't replicate the real world as close as we would like. So as to the delegate request, we restarted the simulation and we played market growth where we ran through a recession, which was perhaps more like the real world that we saw ourselves in, especially this year. So throughout 8 rounds, mistakes are inevitable, they're going to happen. But the idea is that we keep going forward and we keep monitoring the progress. So the delegates have really been put through the paces in some sort of a feedback, if you want to call it that. And they've come out on top. I hope they seem to all be still alive and well and thinking. And then in addition to that, what we did is individually they've also run a company on their own for an individual assessment by the net. But they've also been held to a series of different board questions which are in the likes of operations, marketing, finance, strategy, which are pretty difficult. Some of them are easy. It's not that very difficult, but some of them are extremely difficult. And I think after this presentation, the delegates are going to be happy that the simulation portion is over. It's very difficult. But what we hope, and I think we'll see in the presentation today, is that a lot of this learning has been already taken back to the workplace, and that it's a great opportunity to run a real world company without the real world course. So without any further ado, I think I'm going to hand back to Maggie, who's on the CEO program. Well, I think Carl might. Okay, no, that's fine. That's okay. So what did we not hear?
No, you finished, so I think the last, okay, it seems that they heard everything, so it's okay.
Okay, thank you, sir.
Okay, fantastic. So I think we can get started with the first presentation. We had Team Chester. Welcome, Team Chester, and we will get started. So I would like to welcome Team Chester up. I see we have Faze online as well. As part of your presentation. Faze is on.
Okay. Good morning. So I'm delighted to present our team here. We are Farasa and the company is Chester. We are a group of experts ranging from finance, marketing, business development, and human resources. So just a quick overview of where we found ourselves at round 8. What we see here is that sales were around 187 with a cumulative profit of 112, ranking us number 3, as well with market cap, ranking us at number 3 at 278.5. In terms of market share, we find ourselves the second in the market with 18.4%. And we have the highest selling products in one of the segments, the traditional segment. Our policy has been also to continuously invest in our people and in our processes. So we call this an initial strategy because after a few rounds we had to change tact a little bit. Initially we had earmarked ourselves to be as a niche differentiator and cost leader. However, at the time that we introduced the new product in the niche market, we found that we were not the first entrants. So we quickly had to change tact, and we adopted a broad differentiator strategy. So we also introduced a new product in the high-end segment. We call it CAP. There was continuous investment in R&D, and we pursued affordable financing arrangements, and in that we saw that we didn't have an emergency loan, and we were able to also get into affordable financing arrangements. Just a quick one here also is that what we realized is that our core is the customer. We're a customer-centric organization, and we strive to deliver quality products at their price point. And this is evident from the rankings that we have had, where we normally rank second or third.
8 rounds. I'll start with our strengths. As Sarah said, we introduced a new product. I'm sure I'm getting an echo if you can dial it down a little bit. We introduced a new product in the traditional market. The product that we introduced was actually a high-end product, which we moved it to the category of traditional, where we saw a growth of the market segment there. We also enhanced our plan. We had bought in some capacity. We also did do some automations after round 4, all the way going to round 8. In terms of our opportunity, we have room in round 8. We had, when we closed the round, we had a 6.8% of growth in comparison to all our competitors. We had the highest opportunity for growth in from actual to potential market that we could actually improve our plans to get to that 6.3%. We also have the room to upgrade our plan of 24%, a maximum, which we have already done 76% of that in this 8 years. So this is going to be our future plans going forward. In terms of our weakness, our costing strategy initially was a bit on the lower side, but we had very high, our strategy, as Sarah told us, was initially niche market, niche differentiator, and cost leader. So we invested a lot in R&D initially. So our pricing of the product was very high. So that was our weakness initially, which we changed after a few rounds. Limited marketing spend was another weakness, where we actually did not spend a lot in marketing. Hence, this gave us a low. We had a lot of inventory in round 2, round 3, and the biggest cause was we did not market it well. Also, our plant utilization was not at its optimum. If you will see in my next slide that we had a crisis starting from round 3 going to round 5. So in that period, if you can see on the left, we actually did sell some capacity to keep our boat afloat. But if you look at our sales in terms of our variable costs, and if you look at our contribution margins, they improved drastically after round 5. Going back to the slide before, the threats, we had 2 major companies which were a big threat to us. One was Antus, in terms of traditional market, and the other one was Aries, who is a niche differentiator in the low end and traditional end market. Moving forward, in my next slide, as I said, that we had a crisis time. If you look at the graph on the left, but also if you look at our sales compared to our contribution margin, even during the crisis, we actually did give an increase in sales. Moving forward, the next slide. In the next 5 years, we still had room of growing our capacity in these two segments. This is the traditional segment and the low-end segment. We had to increase 50 units per year, and in the low segment of 75 units per year. In terms of automation, in the traditional segment, we had done almost 90%, so we still have room for 10% growth going forward. In the low end, we have already reached our maximum automation.
Thank you, Faiz. Thank you.
Thank you. Good morning. Okay, so just looking at the past 3 years where we did not do well in terms of cost and pricing, we decided to look on the quality initiatives, and we invested a lot in total quality management, investment. So we did this just to improve efficiency and profitability. So what did we do? We keep our cost growth minimum in material costs, and that's why you see even from the last graph, you will see our contribution margin from the fifth round, it started improving, going up and up, and even look at the future, it will be even much better as we move on. On the research and development also, we reduce costs on that area, and admin costs, reducing from year 5 to year 8. Also, we did evaluate our analysis for future investment spend, especially from the customer spend, looking at the customer, because customer is our key area. Looking at the product demand and services. We looked at the staff satisfaction. We invested a lot in staff training to make sure we get more from the staff and reducing the staff cost. We also invested in CSR, being force of good in the society we operate. So, what is our competitive edge, our competitive advantage? One was the customer survey scores, where in some of the segments, especially traditional, we scored very good in terms of our market survey. Our product take and quality was doing very well. From finance, we managed to finance well our investment. We didn't have any emergency loan. We just decided to go for affordable financing products which were in the market. We increased profitability and stock price. So our profit went up significantly, especially from 5th round to 8th round. And also our stock price went up. Good market share in some segment, as I've said, from CAP traditional segment, and also positive key financial ratios, as you can see there. Our return on sales was 15, return on equity, and price earning ratio, which was very good. So,
thank you, and good morning. I think from a finance perspective, we had a very fantastic finance team. And I think over the years, as we were running through our strategy, they helped us a lot to ensure that the financial position and the financial performance of Chester is well managed. And as a result of that, I think these are the key successes, or the key, things that were done by the finance to make sure that the company continues to perform. One is the fact that I think from a debt perspective, initially started saying our strategy was to make sure that we go for affordable finance arrangements. That was well executed by our finance team. We had almost zero or very minimal unnecessary debt. In fact, we had no emergency fund, but even the long-term debt that we took from round 5, we kept it flat up to year 8. And that's the fact that we are continuing to generate enough cash flows to finance our operation. So from a debt perspective, I think we thought we did very well there. In terms of spend, of course, initially in the first rounds, it basically, we did not spend a lot, which is why our cost was very stable. But from around 4 or 5, we started to invest. But even with that, I think our investment was very prudent, as Foya said, especially in areas where we thought it will bring us a lot of advantage in terms of stabilizing our costs in the future years. So we invested in TQM, we invested a lot on people to make sure the productivity index of our staff increases. And when we ended at around 8, I think we are number 2 from a staff productivity perspective. As a result of all the finance arrangement, of course, we increased our stock prices over the years. If you look at the way our share prices was evolving from round 1 to round 8, it was improving. I think we are number 3 out of the whole group of the few companies that the stock prices were improving year on year. In some of the companies we saw in the market, stock prices were going up and down, but ours was very steady and gradual improvement over the years. And obviously, in terms of financial and key ratios, they were very good, as shared by Foya. In terms of the future plans that we have, our aspirations, obviously we completed round 8 in a very good footing. The ratios were good, but of course we aspire for more. There is one company that is still leading the group, and we want to make sure that we catch up with them. And of course, in terms of what we aspire in the next few years, these are the key ratios. Return on sales at 20.1%. That is our target next year. I think we ended round 5 at 15.8, so we want to get at 20%. Return on assets at 16.2, we ended round 8 at 14.3. We want to improve. And a return on equity at 23.5, asset turnover 1.2. And in terms of sales forecast, we want to get at 192. We ended at 189 in our last rounds. Our profit will increase to 32.5 from 29 million. Our stock price ended at 139. In the last round, we want to get at 152. And obviously, our market capitalization at 305. And the way we kind of crafted these ratios or targets, we look at the companies that are ahead of us. Andrews and Baldwin, Force, if you look at where they are from all of these ratios, our target is to make sure that we are either number 2 in some of these ratios or number 1. So they are not far-fetched. We look at where they are from all of these ratios, and we think that we can get there with all the strategies that we are running. So we did not really craft this from the air. We looked at where they are, and of course our aspiration was built on the fact that we want to catch up with them in the near future. All right, so those are our future targets and what we aspire to achieve in terms of the targets and ratios. So how do we get there? How do we get into those ratios? How do we get into those forecast sales? What do we need to do now to make sure that we achieve those aspirations? We have a number of areas that we want to continue to focus. I'll share the first 2. Of course, my colleague will come and share the rest. So number 1 is a continuous investment in automation and capacity. I think as we shared in the beginning, we started with low investment in automation and capacity, and of course that affected us. In the first rounds, we realized that problem at around 5. We started to invest on these areas, but it was a little bit too late. So in future, we want to make sure that our investment in those areas, especially in the traditional and high-tech segment, continues to be robust and enough to make sure that we continue to penetrate the market that we want to succeed. Our investment in R&D, especially on the current product range, and new product as well, will have to continue. We saw the advantages when we started to invest in R&D, and we would like to continue on that footing.
So in the interest of time, we're just going to wrap it up very quickly. I'm sure you've all read through that. So our investment strategy will continue through the 2QM programs. We'll continue to optimize on our costs. as well as some inventory systems, just to prevent the stockouts that we were generally running into, and also to help us not to also carry high inventory. So, and lastly, we want to improve customer awareness and accessibility. As we say throughout the presentation, our marketing spend was very prudent. And so we want to be a little bit more aggressive in that area, especially in the high-end and performance segments, which are the faster growing portfolios amongst this competitive market. Thank you.
Can we raise some questions?
Yes, please.
First, we would like to understand the basic assumptions and what is the fundamental behind your assumptions in building this simulation model. Basic assumptions. And how you have collected the data and documented the data for building these assumptions. So they must be, because it's a futuristic, yeah?
I don't know, maybe I can start. The way we started with simulation, we started from a base which was already provided in the simulation. So we didn't start from zero. There was a company we took over from that round. I think our responsibility was to make sure that as we continue to run this company over the years, we kind of improved the financial performance, the market positioning, customer awareness, and all of that. So we're making decisions round by round in order to make sure that some of the metrics are improving year on year. So, for example, when we saw that we needed to make sure that we continue to penetrate in some of the markets, we changed our investment spend in terms of automation and capacity as well, so that we can produce a product that are required in the market in terms of size, in terms of performance levels, and all of that. So we started from a certain base, which already had some performance. Of course, they are not very good in the past, and then we improved from there, from year 1 to year 8. And what you see here is really where we ended. And the graph that we showed in the beginning kind of tells you the picture of the journey that we have been, over the period of time.
I mean, in addition to that, in the market we operate, there are different market segments. So there are market segments where we find the client, what do they want? We analyze the client needs and understand what this market needs in terms of when the client who need the cheap quality things at any cost. That's high end. There is a market where we find clients they need at low price. There is a market where we find the client needs something with a certain size. So by analyzing that market, we come up now with we did our decision and said, okay, which market can we make more profit? Where can we invest? And then by doing that, we started chipping to that market.
My other question is related to in model 8, in round 8 also, there still inventory sold out, the inventory is extremely low. If you see the driver now after round 8, you said that we took over and that whatever rounds we have gone through. But I'm afraid to understand why you could not manage that inventory sold out position.
Yeah, I mean, as you've seen, when you had a view of all the companies, it was a common problem, of course. In fact, I put it that way. It was not only our company, it was only one or two products in some of the segments where they had inventory. So yeah, I mean, it was a challenge. And I think one of the focus areas in future plans that we highlighted was to make sure that we kind of improve on the inventory management. There was a discussion that we had in the group in terms of the fine balance between the inventory maintenance cost, because as you hold more inventory, then the cost associated with that. These are really the market demand. So you need to balance that, but obviously we couldn't do that more effectively. I think in our future plans it was one of the problems that we wanted to address in the future.
Last question is regarding the highly capitalized instruments. Capitalization is very high. If you compare capitalization, equipment and running instruments, your investment is very high. And your capacity is very high, but the result actually will be high. The capacity utilization is comparatively low. If you look at your equipment, investment. Yes.
Yes, so one of our future plans, we understand that, and that's what that's what we put in our strategy for the future plan, to automate more, to make sure we maximize utilization of these assets which we've already invested. So our future plan is to automate and use more technology other than the manual way we should use.
Thank you.
Okay, thank you for a good presentation, Team Chester. My questions. So one, there is quite a bit of changes that we want to introduce based on where we are. It's certainly a new product. You probably have gone through a thought process on how that can yield the fruits you want for the organization, and I had a concept of total quality management coming through, and a number of other changes. Most of the changes that we try to introduce in organizations have to have some fundamentals to make them happen and to make them yield the fruits that we want them to yield. What are those fundamentals that we believe will make these changes successful, and do we believe that came out clearly in the presentation? That would be one question.
Yeah, I think indeed, if I got to one slide, I think we kind of highlighted that. This is down. Yeah. So I think maybe we answer that by using this slide, as my colleague highlighted, particularly investment, of course, the benefits of that. But these three, items here, as we continue to invest, which is why we say we will continue to evaluate and analyze the future investment decisions based on these three main items. It has to be able to make sure that we continue to meet customers' demands. So the investment in TQN, the investment in automation, the investment in capacity will have to be made in line with number one. Of course, another, a driving force or factor for our investment in any decision that we make is on staff as well, to make sure that our staff continues to be satisfied, increase productivity, so decision on training, decision on anything that we do to make sure that our staff, and obviously our CSR team. So these are the three fundamentals that we said we're going to use in future on anything that we are planning to do. Number one, on the market customer. Number two, internally on the staff. And obviously, we want to continue to be the first for it.
Sorry. So also, if I can add that it probably looks like it's everywhere, but the model itself, the simulation itself, there's an inbuilt program whereby there is a level of spend on the HR complement. So as of round 8, we were at 50, which is why we have incorporated this plan to gradually grow to 80 in terms of training hours for our staff. Because some of the product lines where you invest require a certain attitude of employee.
And you probably guessed where I was going to go, because you had said our strategy is anchored on customer centricity, but you want to introduce changes. In most circumstances, the change has to come from inside first, in terms of culture. And you might have heard what Peter Drucker had said, that if you don't address culture, your strategy will be eaten for breakfast, right? And so that component is very key from my perspective. And then now, depending on the approach that has been taken in terms of coming up with a strategy, whether it's bottom up or top down, the cascading element, especially if it's the latter, becomes very key to make sure you're all aligned across the organization. My last question or comment before I hand over to my colleague is around the KPIs that we want to, and I know we have talked about the future plans. Do we believe the KPIs that we have set are measurable, they are time-bound, and they are things that we can actually bring accountability across them in the future? Are they very clear and concise?
Yeah, I think they are clear and concise. Obviously, bottom line is to make sure that we continue to make this company attractive to our shareholders. And I think, as I said during my presentation, when we looked at the competition, what they were able to achieve, and where we are for the market positioning, we thought this kind of performance is really attainable.
This is current.
As we go about it for current year, we look for the future. I think current is, if you go one slide back, you'll see what we've been just back. Yeah, here.
Yeah.
This is our current performance as intended, the final position. So we want to get from here to those, so you will see. So the market leader was Andrew, I think followed by Baldwin, and we looked at where they are from the risk ratios, what they've been able to achieve over the years. And of course, our plans for the future, we say this is measurable, because it's a smart objective. It can be measured in terms of that, and then the future plans will basically speak to make sure that we are able to attain this. So if we are not able to attain, it is clear and see that we're not being able to meet the targets.
Maybe just
And
that,
also, yeah.
you can go to the graph. If you look at this graph, when we started, this is the contribution margin. We started at low level. But when we changed our strategy and looked at the key TQM quality, we started seeing our contribution margin going up. And you see this is around 8. So where we are planning on from here to around 9, to year 9, 10, going forward, I think this could even be much better, which will bring the key ratio we have.
So yeah, just to also bring it home is that the last report at this round showed that we have room for growth at 6.3% of the overall market. There's a way that when we received our data sets, it showed that of all the companies, we have the higher percentage growth. Okay.
Yeah, one last question, comment from me. So thanks for your presentation and well thought through strategy. Quite a few changes you're recommending. But what I did not feel was the relationship between, I did not feel a solid environmental awareness come through to sort of drive some of the changes that you're proposing. So can you just go through the SWOT again and just assure us that that the changes that you're proposing are actually based on what you've seen there?
Okay, so when you say environment, you mean as a team, you don't think we have a handle on the market outlook?
Yeah, I did feel that.
Okay. At this point, when we were analyzing our strategy, our initial strategy, like I said earlier, where we wanted to be as a niche differentiator, we realized that we were not the first to market. There was already a product there that was introduced, so we were already lagging behind. That product was from Andrews. And so what we noticed from the customer survey was that our product was doing very well in this traditional market. We had a product that was very strong. So what we did was deliberately introduce one of our other products into that market. We let it slide into that traditional space to just grab bigger market share in that space where we were already doing well. And so also some of the other things that we did was to enhance plant performance, as you've seen. And what we say is that gradually we increased spending in automation. Initially, we were not able to do that because we had a heavy R&D push to introduce the new product and to, just the product mix. We were constantly, that's where we wanted to focus. We were constantly improving our performance and size of our products. Again, weakness was our costing strategy. We had very high material costs because of the R&D spend. Limited marketing spend. When we look at other people's annual reports, we see just how heavy they were with their marketing. And for me, I liken it to what's maybe happening with even telcos. You can see very deliberately who has the bigger wallets, and ours wasn't. So we had products that were good, but they were just not available to customers. And then again, our plant utilization. So because again of our initial strategy to just focus heavily on R&D, we couldn't do both. We couldn't do both. Something had to. So we recognize that, and that's why we have kind of prioritized it for the future. And so again, I think I've talked about the opportunities and then the threats. It is a very, very competitive market. If I could show you some of the graphs, and I hope some of the other people have them, but yeah, it is neck and neck for a lot of the segments in this market. So the good thing is that we're either in second or third place in a lot of the segments, and then the leader in one. So we're very confident about our future plans.
So maybe just to add on, under these threats, I think this competitive market, it covers everything about the market environment. We looked at it, what our competitors are doing, and we noted in most cases where we had a very high competitiveness on the price. Our product price was still very high, and we say now how can we invest more, reduce cost of our production, and we manage to compete in the market environment. So we looked at it. And that's why even in our future plan also, we also said we have to invest in CCR, our society. We also need to be close to our society so that they can understand our product and be ready to operate.
Team Chester, well done, good presentation, strong teamwork. More than questions, just a couple of points that may be useful for you going forward. Your annual report suggests that there is a slight decline in market share consistently over the last 2 years. It would have been prudent to address that in terms of the future plans, especially because you have currently a strong cash flow position. You're generating more free cash flow every year. And during a time of crisis, it's relatively easier to capitalize on the market going forward, as opposed to your competitors, some of whom may be struggling with cash flow. So it would have been nice to see that in the future plans. The other thing that you might want to consider would be perhaps your product range. You'll find that there is one product in particular that does not do much to add to your top line, and also it doesn't do much to anything. And if you actually eliminate that product, you'll find that the percentages look much better. So as opposed to just replacing it, even if you just eliminate it, your shareholders will be much happier. At the same time, you have addressed the fact that there is room for growth, so perhaps rationalizing the product range to be more in sync with what the market wants will encourage your market share issue that you have. So those two things will go hand in hand, and I think they would help make sure that the next year is much better.
So can I just address the marketing spend? Thank you for your comments. We have recognized that we need to do better in that area. So the last point here, customer awareness and accessibility, speaks to that spend, making our products more available in the market.
Thank you, Team Chester.
Thank you, everyone. Good morning. This is the DB company. We are directors. Here with me is Justin Moller, director of the DB company, and then Charles Maria, director of DB company, and myself is Sebastian Castro. It is unfortunate that one of our directors is not around with us. Frederick Shakanabo is having a board meeting this time. So that is our company and the environmental, the way we operated since we started the company for 8 years. That's round 1 to round 8. I would like to start with the agenda that we have, things that we want to present to you today. One is the background of the operating activities. when we started and the way we ended. And the other thing is the ambition and the strategy of the company, GDP. We will look again as the performance of the company, the way we perform throughout the journey, year 1 to year 8, then team effectiveness, and then learning and recommendation. I will cover the operating environment of the company DB when we started with 5 market segments, traditional markets, low-end markets, high-end markets, performance market, and size market. And we look at the market because we did not start fresh. We started from the result around 0, and we analyze the result of the market and what is available in the market. So from our analysis, we decided to participate in all of the rounds 1 to 8. That is competition throughout the journey of the years that we've been given. So we look at the market. We had 70% of the market was in traditional and low-end markets. Then the 30% was in the high-end performance and size markets. So with the 70%, the automation was very critical to make sure that the cost of production is lower. As this market buying criteria was looking at they were very price sensitive. So we have to make sure that our cost is reduced so that we can be able to sell at a lower price. So the other thing that we also noticed from the market is throughout the market, we were looking at what are the pricing methodology or strategy of our competitors. And because we had the reports from 0, we look at the competitor pricing for us to decide what will be the best price. In particular for traditional market and low-end market, because this market were price sensitive, as I said. And so throughout the market, we were very vigilant to make sure that our price is very attractive to our customers. Look at the buying criteria of all the markets. So the other thing that we did is to make sure that we're accessible and customers have the knowledge of us. So we were looking at the promotion and sales budget, looking at what our competitors are doing in the market and to match them. So we're making sure that we are customer centric. And we also, because we have to grow year on year, we were looking at our capacity capitalization and also looking at what will be the sales target for year on year and the production target. So with that, we have to make sure we analyze what is the growth target for each market segment to understand what will be the market capitalization throughout the years and also the sales target throughout the years. So, as I said, the customer centricity, we are looking at what is available in the market and what can we add to make sure that we get customers on our side. And that's why we introduced, if you look at the cycle, Dales was in the traditional market, and then we have Dales in the traditional market, and Dale in the low-end market, and Dixie in the high-end market. With that, we try to introduce new products. I think DP is the company with so many products compared to other companies. That is making sure that we get more customers on our side. And we introduced Dudu and Dico, and we introduced in the high-end market. And also, Dot was in the performance market and Dune in the size market. That is the end for me, and then I will welcome my director colleague, Charles.
Thank you, Sebastian. From Sebastian opening and the backgrounds, this explains our ambitions, our strategy, and our execution, as well as our innovation. Both of those things are focused on customer, consumer-centric. Now, if you look at our ambition, one is to just give and offer our consumers meet the expectations and exceed by giving them the range of products. Now, how do we meet that ambition? The strategy is to have a more range of products placed in various segments. And if you look at all the companies that we have for the operations, it's only Digby which has 7 products which were placed in each segment. So in terms of the strategy, we placed each product in each segment, and in fact, in some of the segments, we placed 2 products, and we were looking in more futuristic way that in future one product may get out of the markets, but we still have other products that we can develop in the portfolio. So deeply from the strategy perspective and the ambition, we had a range of products in our portfolio compared to any other company, and we were looking at that in a futuristic way. In terms of executions, we placed all these products in the segments, in each segment that we are operating. Through our ambition and strategy, we were also embarking to innovation. So Sebastian has explained it. We had two innovations around the way from round 1 to round 8. We introduced the two products, which is Lulu and Dico. And as the progressions and the competition was going, the products were starting gaining the share. I welcome my colleagues to take us through the performance ratios and KPIs.
Thank you, Charles. So in terms of sort of like Sebastian has said, we continued to scan the market and also the competition follow through, just to ensure that, as our ambition says, we want to be the most admired company with provision of all the range of products that are available in the market and serving all the segments. So we also ensured, at the same time, also ensuring that our performance matrices are all in order and also progressing positively. So, and I mean, we chose 5 different performance or financial matrices to measure ourselves that we are actually doing the best, and we said we have a company that is sustainable and is a going concern business. And as you will see, on return of sales, return of assets, and also return of equity, we've been improving from round 1 to round 4, and then we had a bit of glitch in round 5, deliberately so. Because we also, like I said, we continued to see what the market is doing and what the competition is doing. And we actually noted that we're not doing well on automation. And so on round 4 and round 5 and 6, we had a choice whether to invest slowly on automation or we just take a bullet and invest heavily, aggressively, so that we ensure that our products are actually, the cost of production reduces significantly and give us a competitive edge in terms of pricing. So we made that decision, it actually paid off in rounds 7 and 8. And then we would see by round 8, we were actually the best company in terms of return of assets, return of equity at 26.8 and 28.7. And then also even return on sales actually improved significantly, almost 20%. And if you look at other matrices on asset turnover, has been improving, getting to 1.3 times as of round 8, and also leverage rate also reducing or going down significantly. I think we reset our company at round 5 and round 6, and then we really set our business. And since we're really sort of running a going concern business, that will be available in the next 100 years, not just the 8 rounds that we've done. We ensure that we are going to conquer the market and emerge, be able to live with the ambition of being the most admired company that ensures it has product range in all the product in the markets.
Thank you, Justice. Just to take over from Justice in terms of the execution as a company and as a group, in terms of the team effectiveness, I'll start with the team profile. We had a CH and a different diversity of our backgrounds from manufacturing, image, banking industry. So we had a lot of different skills in our group, and the combination of the skills brought us a CH to do execute our roles in the group and running of this company. In terms of execution, I think we chose to focus in each of the brands, and we added other brands in each rounds. And in terms of the engagement as well, we had a mutual respect. We had a different capabilities, we had a different skills, we had a different competences. As well, we know from manufacturing, we have some of the things that we always believe. Our colleagues from the bank, they always believe in the other thinking. Our colleagues from energy, they always believe on other thinking. So we had a synergy and the combinations of which brought us a mutual respect and embracing each one idea to get things done and to run the company. In the first 4 rounds and 5 rounds, I think we saw, and Justin has explained it well, we had some challenges because of different ideologies and thinking. But at round 5, we started now synchronizing our thinking, and we started seeing now the company starting picking up, and we started doing the turnaround of our company. So in terms of the team effectiveness in general, we had a great synergy resulting from team profiling, execution, and embracing all the ideas that were coming from the group. I would like to welcome my colleagues, Justin, for their questions and recommendations.
Okay. So, conscious about time, because I know we've given 10 minutes and we're almost there. Just really briefly on what we've learned in the 8 rounds, which will really help us as we move on to this business-driven higher heights. One was really around working capital management. We took a decision of increasing the number of days that we pay our suppliers from 30 days to 45 days. And that was really in essence of improving our working capital. But it actually did land well with our suppliers. Some decided not to deliver raw materials to us, and impacted our plant utilization and also capacity. So that we learned, and we had to change it around 27, and we saw some progress. I think the biggest learning for us is in a market where that is very competitive, you have to really be considering what other players are doing. You can only afford to do that if you are only a very dominant and monopoly to really be able to dictate some of the payments for suppliers. The second one was around total quality management, and in here we invested very little. We only really tried to invest aggressive around total quality management, so that we improve our operational expenses, which would have given us some impetus in terms of our pricing and of our products. And then a response to market insight. You will see we took a delayed decision. We saw that some of our players, other players or competitors, were actually investing heavily on automation. We could have done that in round 2 and round 3. So it took us some time to do that in the environment 6. It's one of the insights that we're carrying forward. That as you operate in a very competitive market, the insight that we generate, please don't procrastinate. Take decision right away, and so that it gives you a competitive edge going forward. And lastly, being a futuristic mindset. And not that we didn't have, but it's something that we've really learned from this process. Because we did sell our capacity in the traditional segment earlier, I think it's around 12 and 3, and then we would see all through, and it's a market that have 31% market share, which is significant. And then, so what happened is we ended up selling all our products, and we also delayed to take a decision of investing in capacity and business. But then we've taken the lessons, we reset the business, and we're running the business that is going to conquer everyone. And like we said in our mission, this is Digby is going to be the most admired company going forward. Thank you.
Thank you very much, Tim, for a very good and elaborate presentation. Just a couple of questions, and then I can hand over to my colleagues. One is really whether there was a thinking, and just talk us through how you went about, because we have a wide portfolio of products, and I noted that you probably have more market share in the high end, and probably a bit low on the lower end. And so now the thinking in terms of how you went about looking at your portfolio, whether that gives you optimum results, to still decide that you want to proceed and produce and introduce new products, two more new products. Is that a good strategy for you? And just talk us through that. In terms of now pricing as well, because I heard some comments around obtaining or reducing prices and being price competitive. I don't know what that meant. Given the fact that you're operating on the high-end segment of the market, and probably there's an opportunity to be thinking about premium pricing in that respect. So just talk us through that. And then the last one, and I can repeat when you want me to, is that given the investment in the new product and some of the changes that we want to take through in the strategy going forward, you will notice that if you compare to the competition, probably in terms of cash position, you are probably having the lowest cash position compared to competitors. And given probably the product range and some other reasons from the working capital perspective, you're finding most of your investment compared to other competitors is tied to inventory. Your inventory levels are the highest of the competitors. So how are you thinking in terms of now obtaining the funding that might be needed to make these changes that you want to put across in terms of the product? That would be my third question.
So let me try to address some of the questions. So the first one in terms of products, yes, indeed we've launched 2 new products, and they're all in the high-end segment, and we have 3 products in the high-end segment. Our ambition is, as much as we sort of launched more products, we actually have more products than any other player in the market. Our ambition is really, if you look at the market, 70% of the market is in traditional and local segments. And our ambition is to graduate some of these products that are currently in the premium markets or the high-end markets into the tradition. And we do that as time goes. And we felt that it's good to, because the high-end market requires a product that is very new. And so it stays there for some time. Then as it goes, the traditional lower-end requires products that are really staying in the market for about 3 or 5 years. So our idea is get money from the highest market segment with time. And then as time moves, these products are graduating to this other market, so traditional and low-end market, such that at that time, because none of other colleagues have, or competitors have sort of innovated in those segments, it's easy for us to now have a product portfolio that indeed plays where the bigger market is. That's our strategy, and that's the thinking, that's the reason. We still believe that it's still okay for us to have more brands or more products in different market segments with the intention that where exactly we want these products to be sold. The second one is, was it on investment?
Yeah, in terms of the pricing, you mentioned the difficulties of using price in terms of the traditional market and gold market. We understand that, and we know that it is very sensitive to us. One thing that happened first round is our delays in the decision that we took by actually selling capacity and not automating, and that by itself made us sell all our inventory in these markets. And for price, we will look at the market, or what the market offers, and it can be a bit expensive because we don't have much units to sell. But in terms of the high end, this market doesn't look at they're not sensitive to the price. So we will look at what would benefit much the digital company, and can this product be moved away after say 3 years to the traditional market or local market. So in terms of pricing, we are looking what market does and what can we get from the market by giving the market the price that we believe that it was right price for us.
Just to add up on the answers that my colleagues have given us, it's in terms of the new productions which we have introduced in the high end, Justin has mentioned it well, that we were introducing them, and then when they graduate, then in future, because our company were mostly futuristic, when they graduate these products, we can increase the price for the products that we are existing products, But when we increase the price, we have some consumers who can downtrade. We can capture them through the new two products which we have introduced in the same segment. So the two products which we were waiting for them to graduate, we were looking at them in future. We increase the price for the existing, and then we can capture the down trading from the new product that we have introduced. That's why we have a higher portfolio. In terms of the cash positions in the inventory question, which is the working capital element that Justin has touched basically in his slides. True, we have higher inventory, but this was the results of low investment that we made in the automations, which resulted to high cost and our product becoming not more very competitive. But and that's why we were not very able to take up the pricing because of the low margin. But now in round 5, we did heavy automation, and as the rounds goes up, we see the sales coming up, and there is an improvement on return on sales, which would have resulted as to saving on the cost of production, and then we would have compete in this segment of low end and high end, low end and traditional with low pricing, which would have resulted to at least having higher volume and generate more cash, but as well deplete our inventory in that category.
And then also just to add on the same, we've done massive investment already, so our view is going forward, we don't necessarily require a significant amount of cash. So in as much as the cash levels that we have at the moment may seem not very significant, but because we've done all the necessary investment really to set this business for success, we believe that, and all the products that we have, I think the little money that we have will just be using to improve on customer awareness and accessibility so that we deplete all the stocks. At the same time, now that some of the brands will be graduating towards where the battleground is, where the 70% of the market is, they will be selling more, and you will have seen also from round 7 that our revenues are going up, so that also improves our cash flow from operations. So we don't necessarily see that there will be a need to seek a financial sort of support. We've only had one emergent loan in round 1, and that's it, and we operated for 7 years without any support of loan from anybody.
Some of your products have negative margins. Is there any rationale to carry on with those products? Specifically, one is negative, one with very small margins. What is the rationale for that? Or you want to exit from that product line? That is my first question. Second is, you have retired your 100% debts. Of course, the same question was raised by him also. Does it make sense in terms of prudence to retire 100% debts and to run a company at a very low cash balances? My third point is, if you look at second one is about debt retirement. You retired 100% of your debts, you are a debt-free company now.
Yes.
On the other hand, you have a very, very negligible cash balances, you are working on a very thin cash balances. Does it make a business prudence to carry on with this kind of risk, to take this kind of risk? The third question is about the market share. If you see, from 21 to 25, the market share has been going down. Right? But you are projected from 25 to 27 is going up. But what are the learnings from those downward trends, from 21 to 25? And same with the asset turnover. As you look at asset turnover from 23 to 25 or before, it's going down. What are the reasons for that? That's all. Thank you.
I'll start with the negative margin. As we explained in the beginning, when we started round 1 to round 4, we did sell the capacity, and then next we did not invest on total quality management significantly. And also we did not invest heavily on people. So cumulatively, from people we had a lower productivity, and from quality we had low efficiency. And this triggered a high cost for our material. If you look at round 1 to round 4, you realize that if you compare with other players, we have significant high cost of production, and this has resulted in triggered some of our products to be very expensive because of heavy product costs. And it has, in some instances, it has resulted to negative contribution. But the negative contribution that you have taken note, this is a result of the decision we have taken as a company to increase the accessibility of our product to customers. So we had a huge investment on that side, and as well the customer awareness. So we started investing in customer awareness, accessibility, and we invested on total quality. So the product cost in future will go down, but as well the awareness and the accessibility of our products, because we are doing huge investment on the promotion and customer and sales budget. The customer will be aware, and we can start increasing the sales. So these products, we believe in future, there will be a turnaround from the negative margin to a positive margin.
Thanks. I'd like to respond on the cash. I think cash has been very key, and as you said, it's insignificant. But I would like to go back when we were in round 5. There was a decision that we took, as we said, on the automation. But there's another decision that we also took. And actually, I'm happy that my colleague did not chop my head, because I was there with the engineer of that decision by telling them, you know what, the cash is not enough, just delays paying our creditors and push for the debtors to pay, our debtors to pay us. So we moved that from 30 to 45, and that actually almost killed our business, because we had a capacity, but we cannot produce because our suppliers were not willing to supply us raw materials, and we could not produce. So that was the major key that hits us cash-wise, because we planned the production, but we could not produce, and we could not sell. But as we said, from round 5, things have changed with automation, with the heavy investment that we did in TPM, HR training. One of our director who is around with us, he was the pioneer. He's a finance professional. He was the pioneer of employees training. Every time training. So we did investment, and that we are seeing improvement for round 5, 6, 7, and 8. Our graph is actually going up.
And then also on debt retirement, it's not really our deliberate decision to retire the debt. It's just that the maturity of the debt had arrived, and we saw no need to extend it. At the same time, because we still felt, because we had already made some investment, the necessary investment really carry us forward. We just felt the little cash that we have was sufficient. Instead of incurring some additional finance cost for keeping the debt in our books, we can only take that when there is a need to do that. And finally, on the market share, indeed, our market share has been on decline, especially from round 1 to round 4 or 5. But then after the decision we took for improving the necessary ingredients and the elements that our consumers and customers prefer on different brands in different market segments, we have seen an improvement in market share, and you will see from round 7 and round 8, our market share has been improving. And I think it's just the upward trajectory that we are forecasting going forward. And like I said, since we're running a going concern business, we're very sure that our ambition of being the most admired company will indeed be the market leader in few years after the 8 years that we've done.
Product costing. In your case also, and this is the both weakness in both the cases. That reflects a big weakness, because if you cannot manage your cost, whatever you do, later or sooner you will be out of the market.
That's accepted, and I mean it's that's why you see one of the learning indeed we've learned. It's really about improving our cost. So there's all piece around asset efficiency. At the same time, also improving on our product costing on raw materials, at the same time on labor, and that's why it requires a lot of investment on TQM. At the same time, training of our employees, because when you have employees who have low morale, at the same time the efficiency goes down. So indeed, we agree with you, and it's one of the biggest learning that we've taken in the 8 rounds that we've had. At the same time, we've started implementing some of this, and as going forward, even in our workplaces, it's one of those elements or learning that we've indeed taken. Thank you.
And it's good to see that this is the first year that you're coming from a negative cash flow position into a positive cash flow position, so good on you for doing that. Similar to what my colleagues have said, one of your products is actually a negative margin product. And it would be good to see how you address that, keeping in mind that you do have some room between your actual market share and your potential market share. So how you can rationalize once again your product range to make sure that you capitalize on that opportunity by supplying more of what the market wants. I will also continue to keep a close eye on the cash flow position, because you are cash flow challenged, and compared to your competitors, that's something you need to keep an eye on.
Thank you, So we have Team Andrews up next.
From the inefficiencies that have been brought by the monopoly. So these different companies have actually been split from monopoly, and then we had to sit down as a team and think through in terms of the strategy. Given the fact that we understood that there are different segments in the market, but from the inefficiencies that are coming from monopoly, we knew that there is an opportunity from all those different segments. And we, as a management team and a leadership team for this organization, we decided to go for a broad differentiation strategy, which is really intended to make sure that we're actually strong in the different segments that exist in the market. And we did this by making sure that we're producing excellent design, high-end awareness, as well as ease of accessibility. But understanding the different segments and making sure that we're positioning our products quite well within there. And also, from the organizational point of view, we saw the need to invest in an R&D competency. And you can see this one, whereas throughout the rounds and the years, we actually remain to actually be very strong, and we invested heavily in R&D, in making sure that we are meeting the customer's demand. And also, we looked carefully in our pricing strategies, and in following our presentation, I'll actually be able to demonstrate that one to you. Additionally, in terms of our strategy, we were extremely aggressive, and we spent above the market average on promotion and sales to drive and maintain the higher and average market share. And this one you can actually see almost throughout all the rounds, and in our key products, we managed to maintain 20% market share. So we had ups and downs here and there, but overall you actually be able to see and demonstrate on the results. And we strategically focused on, we actually had a pivot of strategy in between, where we saw that there was a lot of growth that is coming in from the science market, 20% growth, which is completely very good, so we were actually futuristic. So we invested in it, we brought products in that segment. And even when recession, and one of our key strategies, R&D, as well as in our plant utilization, which I'll also be able to demonstrate, automation, we came in very early and spent a lot in automation, which actually saw us through really different and difficult time during the recession. In terms of the market positioning, as I said, broad differentiation strategy, and we had a keen eye, as much as we understood all the different segments, but we knew exactly which company, which product that we are actually keeping an eye on. And at any particular point in time, we'll make sure that we're positioning ourselves better, we're pricing ourselves better, and we know where that company, where that product is, to making sure that we stay ahead of the curve. So if you can look in terms of the key strategies in between, is maximization of the sales turnover. We achieved 108% increase in the sales turnover, and this is really through the mass production that we were able to do. If you look at our plant utilization, at all the times we were above 100%, and at some stage we went all the way to 200%. And this, of course, was through the strong enablement that came in from the automation that we have, as well as the investment in the TQM focused on reduction in R&D time, and we were able to be ahead of the curve in bringing those products that are actually needed in the market. Cursors, right. I said, as much as we were actually broad differentiation, but we were very clear in terms of where are actually going to be our cash cows. So from the beginning, we knew this market, the low end and the traditional market, had bigger size. So we ensured even our automation level in those markets went by very fast, so that we were able to be able to bring about large volumes, and we were able to maintain the market share. If you look at another strategy that we had, this was maximization of profitability, and this was total focus on the contribution margin. And this contribution margin, you will see, we went all the way to 60%. And this achieved through a plant maximization we talked about, material cost reduction. We managed to get up to 30% material cost reduction if you look from all the years of operation. We managed lower costs. 47% reduction. We manage inventory level. As much as we also had some stockouts, but 88%, we manage in reduction in inventory management sales ratio. As well as we deployed effective marketing and sales strategy to achieve reasonable price for the products throughout the years. And this is just a demonstration, and this is our contribution margin. We went all the way to 60%. And I'll take a note of some of the decline in contribution margin, although it's still way above the market, but I'll explain to you in terms of what we've learned out of it and what we are planning to do in the way forward. And again, within that maximization of profit, despite the contribution margin, we also look at the the bottom line. And within the bottom line, we were very conscious in lowering the cost of finance, so that we actually making sure that our net income is actually still strong, and early repayment of long-term debt, to making sure that we are maintaining that. But to the contrary, we really were heavy in terms of spending in R&D, promotion, sales, and admin. And quite a lot of time, this has brought a lot of friction within the team, but this was our key competitive advantage. As much as it's a cost, but it's a cost that was actually bringing out sales, was actually making us to actually have an appealing product, and making us to actually be able to capture the customer satisfaction and the market share that we actually demonstrated throughout. And the other strategy that we had was really the share price. The 33% increment you're seeing there, that is just in the last 2 to 3 years. But if you look, our share price increased almost fivefold from the beginning, and it is actually almost 68% ahead of the next best competitor that is there. So this is really a strong performance, and in terms of the cash flow, we managed our cash flow very well. We didn't have an emergency. So this is just another summary of the key KPIs, which I've actually gone through it very well. I'm not going to repeat it. But let's just now go into the financial performance. Overall, this is the highest, this is a dominant player that has actually achieved, a great success in the last, 7 years of operation. And this one is deciding to challenge me. So in terms of, if you look at the cumulative profit, we are more than twice to the next best competitor. If you look at the contribution margin, you've seen 60% achievement. If you look at on our balance sheet, we are the strongest balance sheet position, and we are the second highest in terms of average return on equity, and the highest in terms of sales over the years. Reflection and recommendation. And here we are reflecting from our SWOT analysis, looking at our strength. I've talked about it already, looking at our weaknesses, and looking at our opportunities that are actually in the market as well as threats. So we've looked at that, and we've realized that the key strategies has actually been early automation, very clarity on our strategy and executing it, and with a growing production volume, Andrews progressively continuously increase in TQM so that we actually managed to lower the R&D ratios. Areas of improvement over the last 7 years, maximization of shareholder value. We held so much cash. We could have actually done better there in terms of increasing the shareholders' value and actually release share dividends. but future investment we could have afforded, especially acquire stakes in other performing organizations. With our board strategy, we could have actually managed to acquire companies such as Digby, which was really good in Hyatt, and actually bring them in so that we can actually maximize our position. And then the investment in TQN is really good, and it's actually something that is quite positive. And then the need to transition some of the product lines, some of those that we actually start seeing declining in the market trend. And then on that note, I'm done. I'm just going to welcome my team here so that we can come and engage with you. Thank you very much.
Can you hear me, right?
Yeah.
Thank you for your presentation and all the efforts that we use. I know that you seems to be rushed in terms of time, and I did not get it quite clear the link between the environment, SWOT, and your strategy. If you can just tell me quickly, did not come quite clear to me.
Okay, so from the beginning, from the early on, we understood the market, we understood how the sensor subsector within the IT sector was actually performing, and we saw the opportunity, and these opportunities that we saw was existing in all the segments, and that was really the foundation of really our take on of the market. And then eventually we were very much on the lookout in terms of in understanding the market preferences and the changing preferences, and actually being able to do the right reflection internally to making sure that we are positioning our products within the right positions. And then even towards the end, we looked at the growth, and understood where the growth is coming from, and actually be able to start investing in those areas. As much as we were as a dominant player, we were very strong in the traditional and the low end, but started investing strategically in the areas where we saw the market shares are actually growing, which is really on the performance and size. And for now, we were actually able to bring out a product in the size market. So that was our understanding. And of course, also in terms of the threats and understanding the recession, we really banked on the automation, heavy automation, that really saw us achieving some of those results that you've seen. Thank you.
One thing I found missing, which was in our assessment criteria, which earlier also we had mentioned, was basically to reflect on how teamwork and effectiveness has worked towards your growth. You have excellent performance, very nice presentation, and you are at the top among all the competitors. But as a team, whether it was a one-man decision or how everybody has contributed into that.
Andrew team, I may say, is very, very excellent team because of nature of cooperation which has happened, and because of our background. We have people from finance, from operations, manufacturing, but how we have reached here is because we all taken away where we came from in profession, and we started thinking commercial. We all thought in a commercial matrix. So, for example, I'm from marketing background. If you see the market share, you see what is happening, we are pushing each other. And for the first time, to understand how the team was effective, I'm now very much aware. I ask my finance guys, I know financial statements, which I didn't know before I joined this program. Now I can ask, I know costing, I can do it. I know the PCM, I know the margins calculation. So the team was very much interacted, and we did everything in group. And furthermore, before we go for the second round, we had to do proper analysis of the first round. And good with it, I'm only coming from Mwanza. All my 3 members are in the restaurant. So every time we go for a Zoom call and everything, nothing they did on their own because I'm in Mwanza. This also shows that our team was very effective. And for the specific project, even the syndicate, everything we do together. So mixing finance, mixing Ali from operation, mixing Ellen here from finance as well.
taking me as a marketing guy. It was very difficult to identify who's marketing with finance because of the yoke of kind of discussion and how we came together. So the team was very effective, I think.
Okay, thanks. One more quick, you want to say something?
Actually, I just also want to add on that. As a team, we really also have our own roles. Yeah, any decision that we really take has to be challenged, constructively. So, there should be an input from the side of production side. There should be an input from the side of operations. Also from the side of finance, from the side of marketing. So, any decision that we really do before we really mark the submission done, it really has to get a vote from all of us in terms of what will that really mean in terms of our strengths, and it's really going to give us a better results. For the next round. So if we really made any decision, it really had to get the buy-in of each one of us before we submit.
Thanks, Julius.
Yeah, something. I think the results speak for themselves in comparison with all the competitors and so on. But this is not possible if only one person does it. We all have different competencies, and I think the thing we enjoyed most in the team was the fact that we were able to bring in the expertise but also to challenge each other. So if one person is coming from a particular area of a profession, then you're obviously inclined more to work towards that. Now you can see from this result that that's not quite what happened. We really achieved across the board quite some progress, and that would not have been possible, say for example, if I was the one only doing it or Julius was the one doing it. So I think in my opinion, if you look at it from a broad perspective, the results of the simulation really speak for the teamwork that was there.
Thanks. I know we're overkilling the question, but it's a very important question because we've lived through it, and we have gone through the forming and the storming and the norming and the performing. Honestly, there was a time that we actually in storming, but the good thing is we had different personalities in the group, and those personalities emerged to making sure that as a team we remain strong in terms of the objective. But over time we were able to actually really very fast just remain being a high performing team, which is demonstrated through the results.
Thanks. One more quick question. Your cash flow and financial performance is excellent from the beginning, and the graph reflects. So, for your future reflection, you have mentioned how you want to do. Why you are still waiting after year end? Because you have a huge cash and no borrowing. So, in any business, to keep that much cash idle for a long time is not a good sign. So, have you debated or thought about that? To wait for 8 years, you could have started after year 5, I think, somewhere around year 6, whatever financial reflects.
Thank you. From our side, we really took it as part of areas where we could have done better, which is realistic. However, as you heard it from the beginning, from round 5, it's when we had the recession. So, in the recession, cash is king. So, for our case, we said we should now, we should still maintain our cash position because we were just after the recession. So, we need to be relatively careful in terms of how we manage our cash flow. However, should have been just enough to go for around 9. Certainly, we really had enough muscles to pay back the shareholders in terms of dividends, or also even going forward in terms of now going back into acquisitions or new investments. So we really take it as an area where we can done better. However, to our side, it was still a better position for a next round, either for acquisition or for major investments again.
It's good always to be cautious, but only one observation, because seeing your balance sheet so healthy. So from year 6 onwards, because you have returned, there's no borrowing. So keeping that cash gives advantage to your competitor because he is catching up. So you could have created even bigger gap versus your number 2 by reinvesting that cash, acquiring the other companies. Would have given you a big start.
No problem. You have something in mind which you have reflected. Thanks.
Thanks.
Yeah, I think for me, it's, I've seen your plan to continuously reduce spending in R&D. Given the nature of your products, to keep increasing in TQM, which I would expect for a product which is more stable than the nature of the products, it would be vice versa, spending more continuously in R&D and maybe also keep TQM at the same level, not increase.
If I may add, I think the idea was not to reduce in R&D. The system in the simulation actually only allows you spend in TQM for a couple of rounds, I think. So we were limited to that. But as far as R&D is concerned, definitely we would have continued on that path to make sure that we are still within the market and our products are still selling well. So that is given. We would not have stopped on that.
Yeah, because you have indicated consistently low R&D.
I think maybe
did we?
Yes, our key strategies and shifts.
Okay. No.
If it is linked to stimulation,
No. If you look at the results, overall, in terms of our spend in R&D is the highest. And even when I was presenting, I think then this is a typo. This is our strength. It has carried us through. And because of that broad differentiation strategy, it's very important that in all of the segments, we consistently continue to spend on it. And this is not, we're not planning to change at all.
Congratulations to the team for giving the lead to a lady to take us through.
So I'll go quickly through the strategy. First of all, the mission for bulb sensors is to satisfy customers. I think our main driver is just to make sure that customers' needs are met and expectations are met through affordable cost. Our vision is to be global leader in sensor manufacturing. Our key driver, competitive advantage that we go throughout the project is to be broad cost leader strategy to bring growth and protect shareholders' value. And we have achieved this, gained this competitive advantage by, I think, keeping with R&D, production and material costs to a minimum. We will try to bring down material costs to minimum because we know that we need to compete on price, make sure that we are priced below average. We are broad cost leader, so our competition was based on price. But the only way we could achieve this is just to make sure that our production costs are pretty low, and the best thing to do was to make sure that we have got automation. And also our key area of focus also to make sure that we have got presence in every segment in the market. The trend that has been observed and which enhanced our strategic positioning is looking at the segment annual growth through the segment annual growth, customer buying criteria, and continuous improvement through automation and TQM. We heavily invested in automation together with TQM. As a result of this, we were able to improve our average contribution margin from 28 at the beginning up to 59, quite close to the market leader. Who our plan is just to make sure that in the next few years we are able to catch and even beat them. And how did we do this? We were able to do this through an appropriate decision-making process, which was led by a very highly trained and knowledgeable team, but working together, making decisions that we were a very collaborative team. We are sitting down together and sometimes arguing, but at the end of the day, we look at what works for the business, not just for the individual. How effective can we improve the business? So decisions were based on mutually agreed upon terms that at the end of the day they do benefit the business. We have got a team which has got coming from different industry, and we could only leverage that advantage So that's how we actually were able to come up with the right decisions. We started it a little bit slower at the beginning, but we surely knew what was our strategy going forward. We just needed to achieve the high automation, very low cost, so that we can achieve our strategy of providing, being in every category, every segment, but still being able to generate at low cost and low price. So generally, we were looking at this segment, and we were trying to manage these different segments. We categorized them into two, even though there are a number of segments. Some of them low tech and high tech, and we had different strategies for each. We were trying to make sure that we get competitive competitive pricing, also lowering material costs, make sure that we get low material costs, especially for the low technology. And we just try to increase volume wherever we can. For the high tech, because we had invested heavily in the TQM, we had invested heavily in the automation, and we know the impact of the automation was sometimes to increase the R&D, and for high tech customers require shorter product life cycle. So we had to invest so much in the TQM. Some initiatives were helping to reduce the life cycle, the time that the product can come into the market. Again, we're talking about high tech here. We grew capacity modestly at the beginning because of funding, but after that, we started positioning our products. We aggressively increased the automation level to 100% to improve margin through lowering overall product costs. So if you look at all through the industry, we were the most automated company. But we know the impact that it had. We started to reduce capacity to match the industry needs, especially for the high tech. Also, later steadily increase the automation, investing in TQM to reduce the product life cycle. These are some quality initiatives that we've taken to make sure that we put lower pricing. We looked at the TQM initiatives which would control material costs, labor costs, administration, and R&D. And also doing market analysis and respective products improvement. Also considered labor productivity. I think at this point we are among the highest, with the highest productivity index in the market. 123%. That means our cost of labor was like 83% of the normal cost. This really helped us even to get the right size as a result of automation. We did not need very high intensive labor because of high automation. So our competitive strategy, I think I've mentioned this before. We just make sure that we put product in every segment, and in some segments, at the end of the time, we had more than one. We just wanted to increase our customer accessibility scope so that our products can be seen and can be bought. But again, our major strategy is just to make sure that we have lower price compared to the market prices. High automation level and high margins. The market leader had 60 and we had 59, and that's why we're saying that we are quite close to catching up and even exceeding them, because right now, as we're saying that we put the highest automation level and our pricing are the lowest in the market. Also optimized labor complement, starting with 700, and knowing there was a time that there was a recession, so the way which was done in year one by 700 complement was done by 144, and this had a huge impact on process production and also low material cost. Financing strategy, we used both long-term borrowing and short-term borrowing. Also mainly used financing from operation and also optimizing working capital. I'll call upon my colleague to run quickly through the balance scorecard.
Thank you so much, Director Anaeli. We were tracking our performance across across a myriad of KPIs by using the balanced scorecard, which would benchmark us against competition on financial, internal business processes, customer learning, and growth. And we have just listed a few of them here. Our stock price increased almost 2%. Our profit increased from year one about 743%. Product count in every segment, employee productivity was very, very high. So we were really knowing what was being done by the competition through our analysis of the balanced scorecard. Our performance is very clear here from the graphs in terms of profit history from year 1 to year 8, how we grew the profit to the shareholders in terms of return on equity, in terms of returns on sales, returns on assets. So we are doing better and better. And as my colleague said, the futuristic is within the next year, that is year 9, we are going to be at the top. And we are sure of that based on the strategies we share here. In terms of annual forecast, which is based on market growth and our potential segment growth probabilities, especially on low end where we have very high potential of growth, we foresee that all our KPIs are going to grow in the near future. So here we're showing the first year when we started, current year, how much growth we have achieved, and the forecast where we expect to be. In terms of SWOT analysis and the rest, I welcome in Madam Anna, who was our group leader, so the CEO of our company, Baldwin. Please welcome.
Thank you so much, Ungu. And I think for us, we really invested on knowing our environment that we operate in, so we did the SWOT analysis. And the threat that's in the day is just there's better product in some segments, and also economic recession in 1 year, but also market congestion. And our strength is that we are lower in attrition rates and also a high employee productivity. Our operational efficiency is excellent. The quality of our product is as well good, and the pricing structure that we have talked about. There are some opportunities that are available out there and we want to capitalize in it. There's a growing demand in all segments and the market price appetite, but also there's a new product demand. The weakness is that our poor management of the working capital, at some point we ended up having in wrong. But also capacity constraints and also the product offering in some segments and also the product standardization. The recommendation that we have is that we are going to invest more in working on working capital management, but also going to increase our production capacity in high volume segments and avoid stockouts. Product improvement and differentiate to avoid cannibalization. We are going to introduce new products in segments with high appetite. We're also going to further invest in TQM and reduce production costs. We're going to further invest in increased customer accessibility through sales budgets and channel support. Thank you so much for listening to us.
Thank you for the nice presentation. Catching up from your last slide, on the point you mentioned, the plan for the future to add more products in some of the segments. So you as a team, have you not considered to exit some of the products which are not making decent contribution compared to other in any particular segment? You not mention anything on that.
All right, thank you so much. We have considered that in 2 segments, the size segment, whereby we have gradually reduced the capacity up to 150. So we're expecting probably from year 9 and 10, we will exit that segment. And then in the traditional segment where we have 2 products, one of the products, if I recall quite well, is Abo, is beige. Yeah, we have to introduce another product called Bora. Our intention is Bora to be at the sweet point, get a lot of volumes, and then we win out beige. So we have considered that.
One more related to your financials is you are actually have quite a big receivables and you are funding that through the long-term loan in a way. So what's the plan to, because if you have to reach to your number 1 competitor, then you have to definitely remove or keep very low on receivable and inventory while you are funding that through the long-term funding.
Yeah, first of all, I would like to say we have seen that challenge, and that's why in our SWOT analysis we earmarked that working capital management was an issue. So going forward, we are going to renegotiate the payment terms with customers, and in so doing, we are also going to discuss with our suppliers in terms of payment terms, so that to improve the working capital management and reduce dependence on long-term borrowing.
Yeah, maybe for me to follow that, but you're still holding huge cash.
Again, it goes back to one of our recommendations going forward. It's something that we've actually evaluated and saying this is something that we want to do better next time. Is to make sure that we manage better our working capital. I think there are a number of issues, as we said before, because at some point we actually ran out of cash at all. And I think going forward we were a little bit cautious. We were a bit scared to invoke the so-called big L, which has got a very, very high, it's an automatic loan, which has got very, very high interest rate. So we were a bit cautious, I could say that overcautious. And this is one of our key areas that we want to look at, and next time make sure that our working capital is managed very well. But I think part also is not we've not financed the cash by the receivables. We had also invested heavily on automation as well.
Yeah, probably to add on what Anaeli has said, after accumulating enough cash, in the last round, we also issued dividends to the shareholders. So we are going to have a policy whereby every year, from year 9 onward, we will be issuing dividends to shareholders.
On the finance side again, because your balance sheet is interesting, if you compare with your number one competitor, so where you are lagging is a big gap there, because you are not having that much big payable, you have a huge receivable and huge cash, at the same time huge borrowing. So that both sides of the balance sheet never justifies. And since you have a borrowing, so that is affecting your profitability because huge interest is going on, while your idle cash is sitting. So you have to seriously look into that, so that your bottom line can come closer in terms of other competitors, and you can have that advantage. While on the strategy side, you are doing quite well. You are catching up with the number one player. But to do that, you need to have more focus. You mentioned that you were working as a team. So just reflect on that from year 5 to year 8. Now you have moved. You have shown a good improvement. So how all the team members have participated or contributed into that? Can you elaborate on that?
Yeah, so I think there is a slide specifically for that. But we've been working I think we took some few years to try to learn, first of all, learn from each other and understand the whole concept. And that's why when it came to year number 4, we really understood how to deliver our strategy. Because I think at the beginning, we knew what our strategy is, but we just didn't know how to make sure that we delivered. So when we sat down together and start deliberating, what kind of strategy we want, how we deliver our strategy. So when we sat down together and everyone brought his knowledge, his direction, and chose what strategy worked for the company, and we were able to start turning around the company to a better one.
Yeah, additionally, I think we have had a lot of meetings, apart from the scheduled meetings of the program, whereby we were trying to learn more about the industry. We are the only team who visited Dar es Salaam Stock Exchange to get insights on how to run this company.
Thank you, well done. Very thoughtful presentation and business as well, except for some numbers that you have done better, especially knowing the team members.
He has said in one line that the expectations are much bigger.
Yeah.
All the best.
Expectations are very big.
So with that presentation, this actually brings us to the end of our presentations this morning. Seems that we've actually managed to cover all 4 much earlier than we anticipated. The CAP participants, we thank you so much for being here with us today, and also the judges and our guests of honor as well. Thank you all so much for being here. Before we close, I will give the judges some time to finalize their deliberations, but I would also like to welcome our CAP board, COR Roundtable board chair, and who's also one of the leads on our CAP committee, Mr. Sanjay Rukhani. Board chair, if you could please just close us off with some closing remarks.
Sure. I have two daughters, and recently I have had the benefit of having a dog, and it's a she, it's a chicky, she's called Chicky. So
you are the only male.
So I am the only male there. In the CEO roundtable, it is Maggie and Santina, so I have to get a lot of orders. In my TBA, it is Tuset, I have to get a lot of orders. I'm getting very used to this very dynamic, powerful world of diversity and inclusion. And this is what Tanzania deserves. I also see there is a big program happening today down there, which is around nurturing, unique, diverse talent. And I think that is more required. So I wasn't required to be here today, but I think this is one of the best days in my life. David, you know this. It's about 24 months ago that the CEO roundtable, I remember uniquely, I was in a room down there in the corner where I was first presenting the dream of the CAP program, CEO apprenticeship program. At that time, we had done a research, and 75% of the CEOs in Tanzania, and thanks David, we also had a PwC survey with some work done by Ernst & Young, that 75% of the CEOs said that one of their biggest challenge is talent. Talent that could grow companies, organizations, and take the future of the company forward. 48% of the CEOs actually said that their biggest challenge is also hiring. 48% of them actually wanted Tanzanians to become leaders, much more substantial leaders. So it was not only hiring, but retentions become a bigger issue. And really, Tanzanians with the aspiration to become CEOs was unheard of. So this game is for the CEOs in the waiting. And today I saw so many CEOs. Really proud of Anayal. Very proud of Anayal, very proud of Julius. And Julius, of course, I remember that I moved you from PwC into Standard Chartered, and where you are today. Wow, my chest has become very big. Thank you. So, the program really is trying to achieve three things. The first thing is for leaders to understand themselves. Up until you know yourself, you understand your capacity, you understand how you navigate this world, you understand how to bring your curiosity out, your imagination out, how to expand your horizons, become a global citizen, which is global and local citizen, because the world is way too big beyond what we see. And you need to have intelligent ways to really, pick that, know that, and use that, leverage that insights that you have. But it also takes to know yourself. We are all very unique in the world. We are not 100%, and that is why we are human beings. It is about knowing what your strengths are. It is about knowing what your weaknesses are. And sometimes work on your weaknesses, not directly, but by recruiting people who will help you to nurture those weaknesses. So that's the first part of the program. The second part of the program is what you guys did today. And I can tell you, I have seen you from day one. I've seen you from day one. If anybody could have told me that in 12 to 15 months we would have Tanzanians doing what you did today, talking about companies. I know some of you are finance specialists, marketing specialists, HR specialists. Today you are CEOs. You're talking about the company from strategy to vision to quality management to how do you invest, to capital issues, debt, how much debt you take. We're talking valuation. I've not heard Tanzanians talking valuation. That's the global language at the moment, is it not? Your input has to get to some exponential returns, as we call it. Really want to thank, the panelists of judges. This is, the fact that they've come here is not a coincidence. It's a huge respect to you all. I've never seen any panel in Tanzania that is of this caliber. You've seen them, yeah? These are the giants of the different industries, is it right?
Yeah.
It's a big investment on all of you. Really want to thank your organizations. I know there is a third part of the program, which is around how do you really create future leaders yourself. Because the biggest legacy a leader can leave is to create many, many more leaders. You know, your success hinges upon what others can do for you, not only what you can do for yourself. Is that right? And the more you create individuals in your teams who have bigger purpose, bigger vision, bigger drive than yourself, your success will come. Is it right?
Yeah.
So I really like what we have seen today. And I know that whether you like me or not, I'm going to continue to track you in life. You're going to be the champions. It's like our kids. Sometimes our kids go away all over the world. We really can't let them go. It's never going to be out of sight, or out of mind. But really privileged to be in this session today. And I'm very thrilled, very, very thrilled. And I hope that you take time to talk about this program. To talk about it, be loud. Use every opportunity to talk about this. Because I think that we need many more voices. Voices, one, for CEOs to understand, what this program means, but much more for the national leaders. Because I think that is where we need to let our presence be felt much more. We need, imagine in Tanzania if we have 100, 200, 500 of CAP members. It's going to be a different dynamic world. We wouldn't be just talking about, a company like this. We'll be talking about real Tanzanian companies, that could be nurtured and grown to a very exponential level. So from my side, Maggie, when you give me an opportunity to talk, I can talk plenty, as everybody knows. But I just want to thank, first of all, David, who is a director on the board. There's been very, very strong collaboration, over this period. But really, the CAP committee, all of you judges, and many, very incredible all of you. And Maggie, can't forget you, the Strathmore team, my team there. Let's make this big. Let's make this big for ourselves. Let's make this big for our organizations. But let's make this big for Tanzanians. God bless you all.